good morning, and great morning to you. Welcome to another fabulous episode of Exit Strategy Radio Show. I'm your host, Coleman J. Millett, broker and owner of Exit Realty Low Country Group in beautiful North Charleston, South Carolina. So, hey, y'all know what we've been doing around here for a while, but I would be remiss if I did not remind you of our mission, which is to empower our community through financial literacy and real estate education, guys. We're legacy building. That is what we do. For all these years that we have been doing this, that we have been coming into your car, into your home, essentially invading your eardrums and making it into your mind. Hopefully, we are yet still embedding in your heart. For all these years, we've asked you and encouraged you that when you are out there doing things to build a financial future for your family, that you are adding to and creating and building that legacy, that you put a hashtag on it that says that you're legacy building, not only as a flag to wave to others, but more importantly, as a reminder to you to carry on the good work. So, guys, today we've had amazing guests, but look, hey, we keep going uphill. We keep climbing because today, guys, look, I need y'all to grab your notepad. First of all, I want to let you know for y'all that's watching me, I got my notepad. We about to write some stuff down today. We need to know some information. I am extremely humbled and honored to be able to get this guy cornered and make him a part of the Exit Strategies radio show family. We have none other than Jason Garrett Mandel. He is the founder and CEO of the Mandel Family Office. Now, look, I want to tell you a little bit about him before we go ahead and peel the lid back on this can and let all this stuff out today. But he is a renowned author, the author of Demand Transparency. I like that. Demand Transparency. Stop Wall Street greed and rising taxes from destroying your wealth. So look here, he has this bucket that he's going to be dumping stuff out of today on us. So guys, let's be prepared to receive it. Let's get this good information. Let's get this good word. Jason, thank you so much for being on the show with us today.
Or it's my pleasure. What an honor to be on the show. I'm thrilled to be here. Thank you so much.
So you're quite welcome. So Jason, look, I ain't gonna get straight into. I gotta let you give just a piece of who you are, where you came from, what got you here, and what's your driver. So I know I've asked a lot, so if I need to remind you through it as we go through, I will. But who you are, where you're from, and what got you here. Let's go.
Absolutely. I'm happy to share my background. I have been working in tax elimination. I have been working in helping people build their wealth for 30 years now. I can't believe it. Last Wednesday, I turned 50 years old. It is amazing. And every day is a blessing, Corin. I love what I do. I am one of the luckiest people on earth, and I really am thrilled to be here. And my background starts really when I was a kid. My grandfather worked for one of the largest real estate families in the world, the Lefrak family in New York, multi-billionaires. And I had such an honor to grow up with my grandfather. And Corin, I am blessed. I will tell you right now, my grandfather is 100 years old, still alive. I am one of the lucky guys. He's been a tremendous advisor to me my entire life. He has been an incredible resource and taught me so much of what I know. And I actually dedicated the book to him, Corwin. I honored him that way. He's been an incredible person in my life. And I learned a lot. And there was a time I went off to Brandeis University up in Boston, and I wanted to study real estate, wanted to study business. I was going to become a real estate attorney. That was my whole focus. And it's funny, I never became a real estate attorney, but I married. My wife, Dana, is a real big person. Somehow I did it. I got the osmosis. I got to experience a little bit. But my career took an interesting path. I ended up graduating Brandeis and I got a job. I had a year to kill before law school. I graduated college in 3 years and I needed to kill a year, and I got a job on Wall Street. I got a job at Cantor Fitzgerald in the World Trade Center in the 1990s, well before 9/11. So Corwin, I was there before the attack there, and I was not there. I left to join another company, but it was an important event in my life, Corwin, because it really showed me about there's a little bit of hard work part of life, of course, with a little bit of luck. And frankly, me not being there, I lost so many good friends. I think I lost some of the fear that we all have, Corwin, in life. And I basically am so blessed to feel that I was here and so many people were not. And I just went off and I decided to do things that were in my heart. things that might have been against what other people might think is the traditional view. So I went off, I joined a big hedge fund, D.E. Shaw. I didn't like it that much. I ended up joining the Lefrak family. My grandfather introduced me and they said, "What are you going to do here at this real estate company?" And I said, "I understand Wall Street. I'm going to give you guys some interesting ideas." So we started to do different things like trading the IPO calendar, secondaries. We looked at non-traditional investment strategies, things that were not correlated to the real estate market where the family had all their wealth tied into.
Mm-hmm.
So we looked at hedge funds and venture capital and private equity, all these interesting things. And I was involved in that. And then I said to myself, you know what? I really want to look at tax mitigation because we really wanted to see, is there a way of mitigating taxes? And they gave me some
Mm-hmm.
flexibility. And one of the ideas that I brought to the family was to wrap wealth inside of a life insurance policy. I know it sounds crazy, right? Everybody thinks life insurance. God forbid you're hit by a bus. You don't want your family in trouble. You buy some life insurance. They're okay. They could stay in the house. They could pay the bills. That is an important part of life insurance. Corin, I'm not saying that's not a major part of it. It is. And you know what? Anyone that is so selfish as to buy a little term insurance to protect their family, it's so cheap. I always say to people, don't go out to dinner twice in a year and provide for your children and your spouse.
Mm-hmm.
God forbid something happens to you. But reality is there's a lot more to life insurance than just that term insurance. And it's
Mm-hmm.
unfortunate, Corin, very few people understand the power of what life insurance can do, especially for real estate people. Especially,
Mm-hmm.
I've dedicated my career to finding opportunities to help people eliminate taxation, not just mitigate, but eliminate taxation and find ways of really increasing their investment returns by utilizing some strategies that most people would say, "Oh, that's boring stuff. I don't believe in
Mm-hmm.
insurance." I get you. I get anyone that says that. I'm not angry. I don't believe in certain aspects of it too. You know, term insurance is sold because people will outlive the term. Most people don't need
Mm-hmm.
it. You buy it because of
Mm-hmm.
that 1 million chance that you're hit by a bus. That's why you buy it. And a good person does it to protect their families. It's very unselfish because you're not going to benefit from that. But on a selfish side, there are tremendous solutions that we can bring to the table to eliminate taxation for people and allow them not only to make money in real estate, but keep that money in the family, to create the legacy, like you said, and to eliminate the chance of having big swings in your net worth. So that's my background, and we can get deep into the weeds on all these different
Mm-hmm.
solutions. But I just want to thank you again for inviting me, and I'm excited to share these ideas today.
Well, look, Jason, thank you so much for that. So, what I heard you, and one thing I pulled out of what you were talking about, one little snippet of piece reminded me of book Becoming Your Own Banker. So
Yes.
that premise. So tell us how that plays in, because again, life insurance policies, and I mean, money is designed to move. It's currency. I tell people that means it flows. It has to move. It travels from one place, if you will, to another. No matter how we may try, we can put it in a vault, but it's amazing how money in a vault still manages to move. You see what I'm saying? It goes in the bank vault, but the bank lends it out, but it stays in the vault. Imagine that. So let's pick a strategy, man. Give us one that
Okay.
we can go a little bit deeper on than just the surface level on today.
I'll give you the most basic one that I think everyone who invests in real estate should be thinking about. So, what I say to people is everyone knows this term insurance that we were mentioning, but then there's a whole other section of permanent insurance. These permanent policies, a lot of us might have heard about whole life insurance has a dividend like a bond. So, you buy a policy, you have the death benefit as part of it, but the extra money that they ask you to put in gets invested, and you can make 5 or 6% or whatever the prevailing dividend rate of the insurance company is. And the beauty there is it grows tax free. So for a lot of people who are looking at putting money in the bank and getting a dividend through a CD rate or maybe a savings account, getting some interest, problem with all those bank returns is they're taxable. So you're actually not going to keep every dollar. So if you buy a CD for 5%, you're giving a lot of that away in taxes, unfortunately.
Mhm.
So one of the things that we recommend is for money that you want that is looking for a bond alternative or something like a CD, you can roll that into a permanent life insurance policy and you can get that same 5 or 6%, except it comes in tax free. So you can almost really dramatically benefit from that money. So if you're a conservative investor and you like having your CDs at the bank, you got a big checking account, savings account giving you some yield, that's great. But we can enhance that yield by putting that money inside of an insurance policy. And by the way, you get the same benefit of that term insurance that if something crazy happened to you, your family's taken care of. I always call it mortgage protection coverage, because who wants to leave your family with a big mortgage? Now something happens to you, the mortgage gets paid off, done. And then you can add
Mhm.
another level to that. You can say, in addition to the mortgage, I want all my taxes paid for my family for the rest of their lives. So you can leave them a little extra. So these are permanent insurance policies that give people a benefit like what I'm describing. Now we can take it to the next level, Corwin. And let's talk about something like the stock market. A lot of people say, I got to have my money in the market. If my money's in the market, I'm going to make a lot of money. Yes, but you might lose money. So one of the things that a
Mhm.
lot of people do not understand is that markets go up, markets go down. And when they go down, it's not so much fun as when they go up. I think you'll agree with me, right, Corwin? Not as much,
Of course. Yeah,
definitely not.
no, never.
So I'm gonna tell you something. There's a lot of people out there, probably some of your listeners and viewers, that they don't realize that you can get the upside of the stock market without the downside participation. That
Wait
you
a
can
minute.
cap. Yeah, it's crazy. Some people say, well, wait, I may have heard of that, but it's capped. You have a limit to it. And that's true. There are certain products that if the S&P is up 20, you're capped at 9.5. That's all you're going to get if it's up. You're getting
Mhm.
a piece of that upside. And the only benefit you get is if the market's down, like we know the market was down 2 years ago, 20% plus, guess what? You're at zero. You didn't lose a penny. So for
Mm.
people that want to smooth out their returns, we recommend holding their indexes, their stock market investments inside of a policy. So what's amazing to me is people don't know that there are indexes inside of insurance which can grow tax free and have no cap. You can actually get the full upside of a market index without any downside. And my question to you is, there are people that you and I both know that when the market's down, they're crying. They're depressed. They don't go out. They won't even go out to a
Mhm.
dinner. They won't even see them at
Mhm.
Applebee's. We'll see them nowhere. These people are so depressed. They think the world's coming to an end. They're depressed. And I feel terrible for those people. They're not meant to be in the stock market, frankly, if they can't
Mhm.
handle the swings. So what I say to
Mhm.
them is find an index which has no cap on the upside, but has protection. So if the market's down 20, 30, 40, 50, let's say the market crashes, we have a crazy event, market's down 80%. There are products that are flat, they're at zero. And I think there's
Mhm.
a place in the world for that. Now, I have a lot of real estate investors that I work with. And they say, Jason, my money's going in and out of deals. I'm buying properties. I'm looking at different
Mhm.
things. I said, great. It is, I can't be in insurance. I said, wait a second. There's an opportunity here. Because when you keep that money in the bank, you're getting taxed. I know a
Mhm.
lot of people. What they do is they hold their money that goes into real estate. They
Mhm.
hold their money inside of life insurance. And when they need that money, they borrow against it tax free. And that's when they actually, when they borrow, their money is still invested in the stock market with no downside. They get the upside. And if they borrow the money out, they're going to pay a little interest, but they're paying it to themselves normally. And
Mhm.
now their money is working in the market. They only get the upside, no downside. And they take the money out and they go buy their real estate. What do you think of that, Corn? Have you ever heard of that?
Yeah. So that infinite banking concept is impressive. And there's such a tremendous opportunity built in there in order to, like you said, to borrow against. You're going to pay interest. You're paying interest back to yourself. You're not paying interest back to the bank or whatever other private investor may have given you money for this renovation, rehab, acquisition, whatever it is that you may be doing. In concept, as written in a book, is becoming your own banker, is building your own bank.
That's right. That's definitely one part of it. Now I'm going to really blow your mind, Corman. We're going to take it to the
Uh-oh.
next
Wait a
level.
minute. Let me hold on.
Now we're
Let me hold
now
on.
watch out. Anybody who's listening and not paying attention, pay attention right now because this is the meat of the conversation right here. Now, when someone wants to get insurance, normally they say to themselves when they want to buy a property, they say, okay, I got to put down 20, 30%. Bank's going to be my partner on the rest. That's great
Mhm.
for real estate. Now, real estate is not principal protected, as we know. Sometimes real estate goes up. There are cycles where real estate values go down. Over time, things go. What's
Mhm.
amazing about some of these insurance structures, Corin, is the bank looks at it and they see that it's principal protected. They see that it cannot go down in value. They're is no potential for a loss. So what does the bank say? A lot of smart banks, they come out, they say, you know what? We don't need your 20% down. We're going to finance your insurance contract with 100% financing. People don't get this. They don't recognize the bank's going to put 100% down for you. Zero. So what does that mean to me? It means to me that I say to the bank, how much do I qualify for? Because this is going to give me tax-free income later in life. This is going to bolster my portfolio, my balance sheet. When I go to a bank and they say, we can't give you more credit for more real estate development, even if you come up with a 20, 30%, we're tied to it. So wait a sec, don't worry. Something happens to me, my family's got a lot of money in insurance and they'll pay back this loan. We can even secure additional loans and we can actually collateralize some of those loans with life insurance. The bank loves it when you give them life insurance as a form of collateral because they know something happens to you. They're not in business with your spouse. They're not in business with your 18-year-old kid. They're going to get their money paid back right away upon your mortality. So we really believe that financing, the most insurance that the banks will give you, that the insurance companies will give you, is the right move for every real estate investor because they're going to use that policy not just to benefit their family, but to benefit themselves when they're out there borrowing money from banks. This is what I call enhanced collateral to allow them to get the most money from banks because the banks are going to want that 20 or 30% down, but they're also going to be nervous to have too much exposure to one entrepreneur, one real estate developer. And now you can really calm the bank down by showing them that life insurance paid out upon your mortality immediately. There's no waiting for it. You don't have to put a property up for sale. This stuff gets paid out 72 hours after you get your death certificate into the insurance company. It's right away. So the banks are comfortable. So what I want your listeners to think about is what can this insurance do, not just for my family, but what can it do for me as an entrepreneur? What can it do for me as a real estate developer or investor? So now let's get into the meat of it, okay? I've now said that someone should come out and they should buy the most amount of insurance they're entitled to. They should finance it with a bank and they should end up getting that coverage. Now, you're going to say to me, look, it's great to get a lot of money, but normally the banks want collateral, Jason. And you're right, banks do want collateral. Now, if you work with someone like myself, and I invite people to look me up because I got to tell you, I do things other advisors don't. I don't make my money just by being an insurance broker. If I did, I wouldn't be telling you what I'm about to tell you because then I would mitigate or minimize my commissions, the fees I get. What I'm about to tell you is there is something that insurance brokers don't like talking about. And I've actually had a few death threats, and I'm not kidding, Gorman. It's not a joke. I'm not joking about that. I actually have. Some really nasty insurance brokers have tried to scare me from talking about the truth. And you just mentioned my book, Demand Transparency. That's what I'm all about. So my transparency is to tell you that there is something called an enhanced cash value rider. What's all that fancy word mean? Very simply, the broker delays or mitigates or eliminates, depending on the insurance company, the commission. And when they don't get the full commission, you know what happens? The policy itself has a higher cash surrender value, meaning that if we use that rider and the policy gets issued, there are insurance companies, like, for example, big ones like Lincoln Financial. They have a product which can surrender to 100% of whatever you put into it. There are other great companies like National Life. They have a contract which can surrender to 91% of the amount that you put in and gives you tremendous upside, uncapped upside, like I mentioned, in an index. They use the Societe Generale Pace Setter Index, which is a great one. That index, you can get the full upside of that index with no downside. It's amazing. And if you use the rider, then the insurance company, when you talk to them, you say, look, my advisor is willing to use the rider. What's the surrender value on my contract? That surrender value can be 91% of what you put in, which means the bank doesn't need a lot of other collateral. The bank can use the asset that we're financing as the main form of collateral, Corwin. That's what's so unique. Now, if you use your cousin, your brother-in-law as your insurance broker, he may not want to put that rider on because he doesn't get paid the same money. So when you talk to your insurance broker, be very sensitive because this is how they make a living and we don't want to offend anybody. Like I said, I've gotten death threats. I don't want to piss people off. But the reality is, Corwin, this product exists. Lawyers use it, accountants use it, a lot of financial advisors use it because the insurance broker makes a lot of money when you sell a policy. And if you use this
Mm-hmm.
rider, they're not going to make as much, but frankly, it is very good for the client. Gets a policy that surrenders to an amount close to what they put in. So the bank says to the client, you don't need to post much collateral. Why don't you buy a little CD to cover that collateral shortfall? Maybe get a little letter of credit, but there's no big pressure to come up with a massive amount of collateral, which means somebody can get a huge amount of life insurance. This life insurance is, again, not just about the death benefit. We're getting the upside of the stock market. We're getting no
Mm-hmm.
downside. We're
Mm-hmm.
growing. This is asset protected from creditors, Corwin. This is, God forbid, you ever have trouble with your spouse. These
Mm-hmm.
assets tend not to be divided up. The courts respect life insurance and they leave it alone. So if God
Mm-hmm.
forbid, you don't know if your marriage is going to work out. It's a great product for a family. You're still taking care of your ex-spouse. They could be a beneficiary. You're still taking care of your kids, but you may not have
Mm-hmm.
to divide up your funds right away the way you otherwise might in a normal divorce. There's so many
Mm-hmm.
benefits to this. And this is why I say to real estate people, you are going to be correlated to the real estate market. If all of a sudden there's a problem in multifamily, you may have a little problem. Look at the guys that are invested in office space. They're not having fun right now. Let's be realistic. These
Mm-hmm.
people are having a tough time. We're seeing a lot of vacancies and occupancies, and these people are struggling to pay the money they owe banks. Some people, unfortunately, as we know, are going to lose their office buildings. It's just the reality of a cycle. We're in a bad
Mm-hmm.
time. Knowing that nobody, it's not their fault. Nobody could have predicted COVID. We can't say anything about that. There's nobody to blame. The reality is the reality. What I like is you take a guy with assets today, a woman who's got a portfolio of real estate. And I say to them, you have an asset you don't know you have. The asset is because you own real estate, because you were smart enough to build that legacy for your family. You have another asset you could leave your family and help yourself with. Because you own
Mm-hmm.
real estate, the banks respect you. The banks want to work with you. So you go to that bank and you tell them, I want to buy more property. You tell them about the 1911 Supreme Court ruling, Grisby versus Russell, and the famous jurist Oliver Wendell Holmes ruled life insurance is property, no different than
Mm-hmm.
holding. And you go to them,
Mm-hmm.
you say, I want more property. I want to hedge my exposure to property. I want life insurance property. And I'll tell you something, those people who are smart enough to do that, they're going to get a bank that's going to finance 100% of what they need to pay for those premiums. And they're not getting some small policy. They're getting a 5, 10, 20, $50 million policy. You can get up to $500 million in life insurance depending on your net worth. And we help people get the most that they qualify for. I'm very good at that. And why do we do
Mm-hmm.
it? We do it because they have this asset they don't realize. They have an asset with the premium financing. They can definitely leave a legacy, not just in real estate, but now they're going to leave a life insurance legacy. And they're going to
Mm-hmm.
use this insurance in order to get more real estate because that's what a bank wants. A bank wants excess collateral. It's all part of the
Mm-hmm.
same conversation you've been having with your listeners and your viewers. We are all part of that same vision, which is to leave a legacy for your family. We do it with real estate and we do it with life insurance property, same asset,
Mm-hmm.
both property. So that's another strategy. We call that premium financing. We're going to go to a
Mm-hmm.
bank. We're going to get the most somebody qualifies for. That's the foundational strategy that we believe in, Corwin. But it's just the beginning of the work that I do for my clients. You know what step two is? Step
What
two,
is that?
Corwin, it's the step two is to say to them, wait a sec. We're not just going to do this with a great product like Indexed Universal Life. We're not going to just premium finance. We're now going to take it to a whole new level, something that people don't know about. And when I meet with someone's attorney and I meet with their accountant and I meet with their financial advisor, 99% of these guys and ladies don't know anything I'm talking about. They've never heard about this. I've been doing this now since 1999. And these people still don't know what I'm about to tell your listeners. And it's frustrating because we all want to think we're the smartest person in the room. Very few people,
Mm-hmm.
especially people in finance, are too humble. They feel pretty good about themselves. And when you bring them a new idea, you know what their first reaction is? Their first
That's
reaction
not
is
gonna work.
no. And then they figure out why no. But they got to say
Mm-hmm.
no because they didn't think of it. And I'm tired of that. And that's why I wrote the book because I want these people to read the book. I want them to go and understand this stuff because if they understand it, they're going to know their clients deserve this information. Here's where it is. This is very simple. I'm going to break it down as easy as possible, and I think everyone's going to understand it. Corwin, what we do is we wrap real estate inside of life insurance. I'm going to say it again because not everyone's going to understand what I say. I take a property. You take a property. You find some great multifamily you want to buy. I say, wait, don't buy it in your own name. Don't buy it in an LLC. Don't buy it in a trust. All of those entities are taxable. When that rent roll comes in, who's the taxpayer? The trust is a taxpayer, pays cap gains, pays taxes. You're an LLC? Great, you're an LLC. You still pay taxes every year. You're a trust? You still pay taxes, even if you're a trust. The only tax you eliminate is the estate tax. So you did a good job for your kids. You did a good job for other people, but not yourself. My strategies help the families, but they also help yourself. So what am I talking about? What do you mean buy it inside the life insurance? It's exactly what I'm saying. You can actually create another life insurance policy. This life insurance policy has death benefit inside of it, of course, but it's got a whole nother utility, a whole nother reason to exist. It's not just to protect your kids. It's not just to protect your wife. This insurance is to protect you from taxation, because in this policy, you have to hire a money manager. You have to hire a professional. You can't do it all yourself. That's one of the negatives here. Look, there's no free lunch in the world. You can't just say everybody pays taxes and I don't. No, if you're not going to pay taxes on the rent roll in a building, it's because you did something different. What did you do? You didn't pay taxes when you built that building up. You went from 50% occupancy to 100% occupancy and you sold it and you made a fortune. If you hold it in your own name, you pay cap gains. You pay profit. You got to pay taxes. Guess what? What if you don't own it in your own name? What if the owner is not a trust where you eliminate estate taxes, but you don't eliminate cap gains taxes? What if it's not an LLC the way most people buy their real estate? What if it's not in your individual name? What if your money manager finds a great property for you and your money manager buys the property and buys it inside of your life insurance policy? Guess what? You build it up and it gets built up and your money manager sells it and you made $1 million. That's $1 million tax-free because life insurance never gets taxed. Cash value buildup is not a taxed asset. That entity is not subject to taxation. And you might say to me, Corwin, how do I benefit? How does my family benefit if I made $1 million? It's locked inside the policy. I'm going to remind you, every life insurance policy, cash value, or most, I shouldn't say every, but to everyone I know about, allows you to borrow from that cash value. And if you do it right, you borrow tax-free. And that's how you access that money. Now, I'm talking about all these great things, but I would be really remiss if I didn't point out the negatives are your listeners may be used to going out and buying that property and going over to it, managing it day to day, collecting. That's active management. That doesn't work here. Unfortunately, in this situation, if you do that violates the rules of managing your own cash value. You can't do that. The only way that this works compliantly with regulations is if you hire a money manager, that money manager manages the property. So you really would have to hire a firm, a management company that's managing it. If you don't want to do that, the strategy is not for you. And that's fine. You can go manage all your properties you want. But why not scale? Why not build more? You can't manage 100 properties. So you're going to find those buddies. They're going to do a deal. Make your PPLI policy, invest in your buddy's real estate deal. If you trust your friend, let him run it day to day. That's compliant. You're not managing it. And you need to diversify. That's the other thing. I got guys that say, Jason, I can't do this. I'm buying this massive 20-story building, this multifamily apartment house. This is going to be my biggest deal. I'm selling everything to buy this. Doesn't work. In PPLI, you need diversification. No more than 55% of the assets in your policy can be in any one investment, 70% in any two, 80% in any three investments, 90% in any four. You end up with 5 investments. If you can't live with that, it's not for you, my strategy. But if you can live your life with no taxation on that rent roll, no taxation when you sell that building, because you're not selling it, The owner of that building is your policy, and your money manager selling. And yes, you can give a little insight, but you can't control this thing day to day. But this is life altering for your real estate investors. If they can meet the criteria and they're comfortable with what I described, then there is no reason to pay taxes on your cap gains when you are successful in an investment. And you could do this not just in real estate. You can do this in hedge funds and venture capital, and private equity. I know a guy who's got racehorses that he races at the track, and he's an investor with another group that runs it. But it's compliant. He's not actively managing these horses. He's just an investor. So now he's no longer an investor. The new horses they bought through his policy. He introduced the money manager to a guy that's very successful in that business that was compliant if done. So these are some of the ideas, Corin. And unfortunately, on this one spot today, talking with you, I can't go through all the ideas, but I want to a good one. I want to invite your listeners to reach out to me if they want to. I'm happy to talk to them. I have a website called the Mandel Family Office. They can visit it. They can read stuff. If your listeners use LinkedIn, I publish a lot of stories and ideas and strategies right there on LinkedIn. They can type my name in there and they can see it. And I'm happy. And if they go to Amazon, they can get a book. I'm not looking to make money. We're donating all the book sales to charity and we're giving everything away. This is not the purpose to make money. It's to share ideas, Corwin. That's why we're doing it. I actually have a digital version of the book I sell for 99 cents because I want everyone to read this. I think it's crazy that people invest with so much risk. I want people to lower their risk and amplify their returns and lock in the legacy. Don't just build that legacy to see it taken away from you. Lock in the legacy. That's my main message to all your listeners.